How to start investing without the stress, index funds and ETFs. Investing can feel overwhelming when you're new to it. The financial world is filled with unfamiliar language, detailed charts, and strategies that often seem reserved for professionals. However, at its core, investing includes simple tools designed to make the process more relaxed, manageable, and accessible. Two of the most beginner-friendly options are index funds and ETFs. These tools are widely used not because they offer fast results, but because they provide consistent exposure to the market without the need for constant decision-making. Many new investors choose to start here because these investments remove much of the pressure involved in selecting individual stocks and help ease the emotional stress that often comes with investing. Before diving into how index funds and ETFs work, it helps to take a step back and picture the stock market as a vast, constantly changing landscape. Each company represents a small part of that landscape. When you buy a single stock, you're choosing just one piece and depending entirely on how that company performs. If it struggles, your investment is affected directly. When you look at the market as a whole, however, the movement of any single company becomes far less important. This is the principle behind index funds and ETFs. Instead of focusing on one business, you invest in a collection of companies that reflects a large segment of the market. An index fund is built to track a specific market index. An index is simply a group of companies organized according to set rules. A well-known example is the S&P 500, which includes 500 of the largest companies in the United States. When you invest in an index fund that follows the S&P 500, your money is automatically spread across all of those companies. There's no need to choose which stocks to buy, how much to invest in each one, or when to make changes. The fund mirrors the index, and your investment quietly follows the movement of the broader market. This straightforward design is what makes index funds especially appealing to beginners. ETFs, or exchange-traded funds, operate in much the same way. Like index funds, most ETFs track an index and provide instant diversification. The primary difference lies in how they're traded. ETFs can be bought and sold throughout the day, just like individual stocks, which means their prices can change minute by minute. Some investors enjoy this flexibility, while others prefer the once-a-day pricing of index funds. Neither option is superior. What matters is how each one aligns with your personal investing style and comfort level. For beginners, diversification can sound like an abstract concept, but it's simply about spreading risk across many companies instead of relying on one. Index funds and ETFs handle this automatically. Rather than researching dozens of businesses or closely following financial news, you gain broad exposure through a single investment. This convenience is one reason these tools are commonly recommended in educational settings. They help reduce emotional pressure and lower the likelihood of making decisions driven by fear. Another useful way to think about these investments is through time. Index funds and ETFs are designed for long-term growth. Their value doesn't come from rapid price changes, but from the slow and steady progress of the market over many years. For someone new to investing, it can be comforting to know that success doesn't depend on reacting quickly or predicting short-term movements. Instead, you're participating in the market's overall trend, which has historically moved upward over long periods. As you continue learning, the structure behind these funds becomes clearer. But the most important first step is understanding that investing doesn't need to be complicated. You don't need to predict which company will perform best or worry about missing opportunities. Choosing index funds or ETFs means selecting a steady, balanced approach that allows you to grow gradually while learning the fundamentals along the way. As you become more familiar with diversification, it's natural to wonder what's actually inside these funds. Although they appear simple, index funds and ETFs are built on clear frameworks that explain why they work so well for beginners. When you invest in an index fund, you're purchasing small portions of each company included in the index. Those companies are selected based on specific rules defined by the index itself. For example, the S&P 500 consists of 500 large, established U.S. companies and is updated over time to reflect changes in the economy. This structure allows you to own parts of many businesses at once, even with a relatively small investment. ETFs function in the same way when they track the same index. The main difference is not what they hold, but how they're traded. Because ETFs trade throughout the day, some investors use them for more flexible strategies. For beginners, however, the trading mechanics are often less important than the broad market exposure they provide. In both cases, these tools reduce the pressure of stock selection and allow your investment to grow alongside the market as a whole. Cost is another key factor. Every fund has an expense ratio, which is a small annual fee charged by the fund manager. For most broad market index funds and ETFs, these fees are very low, often just a few dollars per year for every $1,000 invested. Low costs play a significant role in long-term growth. High fees can eat into returns over time, while low-cost funds allow more of your money to remain invested. For beginners, this quiet, efficient growth can bring a sense of clarity and confidence. When people first learn about investing, they often ask whether index funds or ETFs are better. For most beginners, the difference comes down to preference rather than performance. If you like investing once per day and avoiding price fluctuations, index funds may feel more comfortable. If you value flexibility during market hours, ETFs might suit you better. Both track their indexes closely, and when they follow the same holdings, their long-term performance is usually very similar. Another benefit of these investments is emotional relief. Investors who choose individual stocks often worry about company-specific news and sudden price changes. With index-based investing, those concerns are reduced. The impact of any single company is much smaller when your investment is spread across hundreds of businesses. This broader exposure encourages a calmer mindset and supports long-term thinking, two qualities that are especially valuable for beginners. As you gain confidence, you may notice that some funds focus on different areas of the market. Some track large companies, others focus on smaller ones. Some concentrate on technology, while others include a mix of sectors or even international markets. While exploring these options can be interesting, beginners usually start with broad market funds because they offer a simple introduction without requiring complex decisions. These funds reflect the overall economy and provide a solid foundation for learning. At this point, the most important thing to remember is that investing doesn't have to be complicated. Index funds and ETFs were created to make investing easier, not more confusing. With one investment, you gain exposure to many companies, reduce reliance on any single outcome, and move with the steady rhythm of the market. As you continue learning how these tools are used in practice, it's normal to feel curious and uncertain at the same time. Questions about how much to invest or how often are common. What matters is approaching investing with patience and calm. A simple and beginner-friendly strategy is investing small amounts regularly. This removes the pressure of timing the market and helps turn investing into a consistent habit. Over time, familiarity grows and fear begins to fade. Because index funds and ETFs represent broad groups of companies, their price movements tend to be smoother than individual stocks. While the market will always rise and fall, the impact is softened by diversification, helping reduce emotional highs and lows. It's also important to recognize that you don't need deep expertise to begin investing. Many people feel they must understand everything before starting, but investing is learned through experience. Index funds and ETFs support that learning process by keeping things simple. They don't rely on predicting winners or following trends. Instead, they allow the market itself to shape results over time. This is why so many long-term investors continue using these tools throughout their lives. Transparency is another advantage beginners appreciate. Most funds clearly show which companies they hold and how they're weighted. This visibility builds trust and helps you stay focused on the basics instead of getting lost in complexity. As you grow, you may choose to combine different types of funds. Some investors add specialized funds alongside broad ones. While variety can be helpful, comfort and understanding matter more than quantity. Investing is not a race. It's a long-term process built on small, consistent actions over many years. Index funds and ETFs fit this pace perfectly. They allow you to start simply, stay steady, and build confidence gradually. Even though these investments simplify the experience, they still move with the market. Their value will rise and fall, and short-term declines are normal. Diversification reduces risk, but it doesn't eliminate market fluctuations. Understanding volatility, the natural movement of prices, helps you stay grounded. Index funds and ETFs usually experience less dramatic swings than individual stocks, but they still reflect market conditions. Emotional reactions are also part of investing. Seeing your investment drop for the first time can feel uncomfortable, but with experience, these moments become easier to manage. Temporary declines are not permanent losses. They're part of the market cycle. Broad market investing also helps separate personal performance from market performance. Your results reflect the market itself, not your ability to predict outcomes. This removes pressure and supports a hands-off approach. Terms like tracking error and liquidity may sound complex, but they're simple concepts. Tracking error measures how closely a fund follows its index, and most broad funds track very closely. Liquidity refers to how easily an investment can be bought or sold. ETFs tend to be more liquid due to intraday trading, while index funds trade once per day. For beginners, these differences rarely affect the overall experience, but understanding them can increase confidence. It's also worth remembering that not all funds are the same. Narrow or theme-based funds can carry more risk. Starting with broad, diversified funds allows you to learn at a comfortable pace. Another common misconception is needing a large amount of money to begin. Index funds and ETFs work well with small, regular contributions. Over time, compounding allows those contributions to grow steadily. Throughout this journey, patience becomes your most valuable skill. Investing isn't about reacting quickly. It's about consistency and alignment with your goals. With each month, what once felt overwhelming becomes familiar. As clarity grows, the path forward feels less intimidating. Investing becomes a steady process shaped by curiosity, reflection, and time. Index funds and ETFs provide a stable foundation that supports long-term growth. Setting realistic expectations is key. These investments aren't meant for rapid results. Their strength lies in slow, consistent progress. Understanding this makes daily fluctuations easier to accept. Investing is also deeply personal. Your pace, goals, and comfort level matter. Index funds and ETFs reduce urgency and allow you to invest in a way that feels balanced and sustainable. As you continue learning, you may explore new topics or tools, or you may find that simplicity suits you best. Either choice is valid. The purpose is not to rush, but to feel informed and grounded. With diversification, patience, and steady habits, you're already building a strong financial foundation. Investing doesn't need to be overwhelming. With the right tools and a calm approach, growth happens naturally, one step at a time.